Welcome to the Investing Money and Markets podcast and video. And this week we're talking about the UK equity market again. And on the podcast, we have Thomas Moore joining us. He's one of the managers of the Aberdeen Equity Income Investment Trust, which has won an award from us in the Online Money Awards 2025, where it picked up the award for Best Investment Trust for Income. So welcome to the podcast, Thomas.
Good to be here, Stuart.
Obviously, very good performance from your trust. And I wanted to basically kick off talking about the trust itself. What is its investment objective, obviously, other than just generating income for investors?
Yeah, it's a great question at the moment because we've got elevated cost of living. So people are finding it hard to make ends meet, and therefore income really comes into its own at this point. So we've got an objective which is an above average yield. So currently we're yielding 6.1%, but we've also got an ambition to grow income in real terms. And we've been doing that over the long stretch. It's been a bit harder recently, but we've got 24 years going on, 25 years in September, let's hope, of dividend growth. So both of those things relate to the income part of the mandate. And then on top of that, we've got an ambition to grow capital as well over time. Now that, of course, will depend on the market's performance as well as our own stock picking in any given year. But again, over time, we think we're proving that we can do that.
And how do you balance that income capital quotient within the trust?
Right. Well, that's a really good question. So on that subject, I don't see any compromise between those two things. Mm-hmm. You will meet managers who say, well, I prefer growth stocks because I want to grow my capital. I just think that's the wrong way of looking at it. We see lots of opportunity for share prices to go up among yield stocks. And when I talk about yield stocks, I'm not just talking about stocks yielding 2 or 3% or 4%, because the market at the moment, believe it or not, only yields about 3.25%. Which isn't a great deal because you can put your money into a term deposit and generate a bit more than base rate. So you can get if you go on the Money Supermarket or whichever website you use, you can see a yield of 4%, 4.2% maybe from a easy access account. Well, the UK market only yields 3.2. Now I can find growing companies with growing dividends yielding 5, 6, 7, wait for it, 10%. Yes, I did say 10. Look, it is possible to find winning companies with those kind of yields. So the reason I say that is that I think most of the managers you will speak to will tend to say, I'll pay up for quality. I will go for lower yielding stocks because there's less risk and there's less variability. So what that does is it leaves this wonderful part of the market with high yield, which is really underexploited, I believe, in terms of active management. These are companies which will explain to me as a fund manager, they will explain why they believe that dividend has been set in the right place, why they think they can grow it, and what are the routes to prove to the market that they can do that. And you know what? Some of the time, not all of the time, but a lot of the time, these companies then go on to do that. And we've got to pick the companies that can do that. And you know what? Sometimes you get a yield of 10 compressing all the way to a yield of 7, 6, 5, sometimes even 4%. So you can see once there's some belief in those stories that those management teams are putting out about the improvement they're making, suddenly the market buys in, the share price goes up, and instead of yielding 10, the stock's yielding 5 or 6, and suddenly you've made lots of money on that stock. And that's why I think there's no reason to say high yield is just boring income stocks. They can be income plus capital.
And does this mean that you're focusing on UK value stocks? Is that
that's right? So exactly. So I think sometimes when people talk about valuation, and a lot of your viewers and listeners will be hearing about valuation, and they'll turn off and they'll say, "Oh, that's all a bit abstract." The way I see valuation, Stuart, really is that valuation can be something that you live and breathe, and it's something quite real. And if I go back to the meaning of this portfolio, this trust, what we're looking for is we're looking for companies that are generating lots of cash and they're paying out some of that cash in the form of a dividend. And you know what's exciting about that is actually then it brings the whole concept of valuation to life. Because if you can find a company which is paying a nice yield. And then you can link that dividend yield, that stream of dividends, to the cash that that company makes. And then you can relate that cash to the market cap of the company. So the market capitalization, what the stock market is valuing that company at. So the number of shares multiplied by the share price gives you the market cap. So you can suddenly see that you can triangulate between how much company is being valued at, how much cash flow that company makes, and how much of those cash flows they pay out in dividends. And suddenly it all comes to life. And you can actually see that sometimes companies can have a free cash flow yield, which is this relationship between the cash flows and the market cap, of 20%. I know it sounds absurd, but if you think about that, there's a bit of discounting you could do about sort of 20%. You could say, well, you need to discount that. But if we keep it simple and say, leaving the sort of the cost of money aside, 20%. If you do 20% for 5 years, in broad terms, you've got all your money back. The company is generated at the same amount of cash flows as the market is valuing it at. 5 years. Do you really think, are there that many companies that will only last for 5 years? I mean, and then suddenly again, you can turn a ratio like the ratio between cash flows and market cap, which is a percentage, into a number of years. Because you can say, well, 20% free cash flow yield equals 5 years. And then you suddenly think, but hold on, that company has existed for 80 years. We really think that a company that's existed for 80 years is going to die in 5 years' time? That makes no sense. And so again, it's sort of valuation is core to my process, because the way I think about valuation is you can make it feel quite real. And then if you think about the valuation in terms of dividend yields, you can then think, well, what am I providing to the shareholders who are investing in my investment trust? Am I providing a stream of dividends that they require in order to meet their needs in their daily lives? And again, then it becomes real in a different sense, which is I'm doing something which is important for people who own my trust. If I can carry on achieving a dividend yield of somewhere in that region of 6, it's been as high as 7 or even 8 in the last 18 months. It's been mad. But, 6 is, I would say, a staging post. We could find that if the share prices keep going up, as they have been in the last 6 to 12 months, that yield could compress further. We could be suddenly yielding 5, maybe 5.5. But at the same time, we'll be finding new companies that are yielding 8, 9, 10, which have got this wonderful potential to re-rate. So it's really replenishing the portfolio. And when things play out, when a share price has hit, the target price where we think it's fair value, maybe it's only yielding 3. We can put that money into something that might be yielding 6 or 7. And so the process goes on, and we can keep trying to make that capital growth for our shareholders, not just the income.
And when you're shopping around the market for the new companies to get into the trust, what other criteria are you looking for beyond those that you've obviously mentioned already?
Well, at the beginning of this conversation, we talked about those 3 factors. So we said yield. So I am looking for dividend yield, and I want that dividend yield to be backed up by cash flows. So I want it to be a genuine, sustainable dividend yield. So that's the first thing. So dividend yield, that's part of the valuation approach. Then we're looking at this real growth in income. So we're looking for companies that can grow their dividends over time, because that's really important. Big difference, by the way, between what I'm doing and what a corporate bond investor would be doing, or a government bond investor. And I know you've had people on your podcast who talk about bonds, and bonds are great for people who want that fixed income. The clue is in the title, fixed. Mm-hmm. Our coupons or dividends are not fixed. They shouldn't be fixed. They should be growing. So that's another thing that we're looking for. So those 2 things, yield, dividend growth. And the third thing is really that, how do we achieve that capital growth? And I would say, to give you a flavour of how I think, I hear a lot of people all over the city talking about some whizzy growth story. And they say, if all of these assumptions come true, we will have X, Y, Z million revenues in 10 years' time. Problem is, they're not making money today. So the way I achieve capital growth is quite different from the way I think a lot of fund managers would think about achieving capital growth. I mean, they would say, look, I've been told this great story by the management team. They've told me that they're going to achieve all this growth. Then something goes wrong. a new competitor arrives, a Chinese tech firm arrives. So you can see what's happening all the time, disruption. So I would say disruption tends to affect growth companies more than it affects value companies, funnily enough. Value stocks, they don't tend to attract a whole load of new capital. I'll give you an example. If you're a tobacco firm, how many new tobacco firms are opening up, selling combustible cigarettes, for example? Okay, there are some new firms who are launching vapes and so on. But what tends to happen there is that gets regulated away because the government and the health authorities say, we actually don't want all this cheap, nasty stuff coming in. We'd rather it was an oligopoly. And so, surprise, surprise, it's the same companies. So that's what I tend to see is in an environment where the cost of money's gone up, it's harder to start a new business and you don't tend to put new capital into what you might think is a mature industry. And a lot of those are the sorts of companies that I will be looking at. And so what happens then is the profit margins of those mature companies has been eking out nice gains over the last 5 to 10 years. It's just there isn't new capital coming in. So that's really the way I see my approach. It's those threefold approaches of yield, dividend growth, and then this capital growth, but it's not in the conventional way that most fund managers would talk about capital growth.
And talking a little bit more about the big picture, last time you were on the podcast, which I think was towards the end of last year, you talked about inflows and outflows from UK equity markets and how that's important. What are you seeing in the market at the moment in terms of those benchmarks?
There's conflicting messages on this. So if we just look at the Standard Investment Association data on the two big sectors in UK equities, which is UK all companies and UK equity income, it's remaining negative. So there's still net outflows according to the Investment Association data. And quite a lot of the other data that looks at active funds is still negative. However, if you look at the overall data, including passives, UK has just turned positive about halfway through this year. So that was a function of the need among asset allocators to make sure that they had diversified. So they weren't just investing in the one big market, which has got all the headlines, which is obviously the US. Obviously, there's been some noise about how diversified you might want to be given all the political change that we're seeing globally. So you've seen that there's been a push. And if you're a Japanese pension fund, for example, you might just want to tweak up your weighting to UK and Europe. Now, initially, some of this money is going into passives. Net does still help the stock market. So it's not a bad thing overall that there's money flowing in overall. But we would obviously like to prove ourselves and prove to people why they should be putting their money into active funds, including investment trusts like Aberdeen Equity Income.
And another topic that we talked about, we touched on last time you were on the podcast, was M&A activity. How's that faring at the moment, and why is that important from your perspective with the Equity Income Trust?
Right. So part of that third layer of objective that I talked about, which is capital growth, is the re-rating of stocks. And the ultimate way to re-rate a stock is actually if another company externally, maybe in an overseas country, says, actually, you know what, all these UK stocks are looking very, very cheap. I'm going to find one of those stocks and I'm going to buy the entire market cap, every last issued share. So that's happened. We've had 12 months ago, so a year ago, we had Centum in Egypt, which is a gold company. We had DS Smith. We had Timon, which is, those two are both industrial companies. And then finally, we had Hargreaves Lansdown. This year, we've had two more. We've had Assura, which is a real estate company. And more recently, we've had International Personal Finance, which is a emerging markets lender. So we've had quite a lot of, and this is in a portfolio of about 50 stocks. So we've had quite a lot of M&A in relation to the size of our portfolio. That I would expect to continue because there's still this mismatch in valuations, mismatch between the UK names and overseas names. So if you trade in, the UK is the cheapest market in pretty much in the world, as far as I can tell. I mean, there are some emerging markets which are cheaper, but there tends to be big political risk in those emerging markets. So the UK trades somewhere between 12 and 13 times. So I would expect that to attract lots of more bids. The other thing I would say is you can also buy yourself back incrementally through share buybacks. So we've currently got 32 of our companies seeing buybacks in this financial year. So I would say, if there is no bid, there's still this daily grind of companies buying back their own shares.
And just for those who may not understand this, what's the incentive for doing a share buyback, and why now? Is it just because the shares are cheap and they're thinking time to get some listed equity off the table?
Yeah, so if you go back to what is a share price multiplied by the number of shares in issue equals the market capitalizations. That's the full value of that company. Now, if you buy back shares, you are reducing the number of shares. All other things being equal, the company's still worth what it was before, so the share price should go up. That ratio will change. There'll be fewer shares, but the share price should be higher. And why is that something that should happen? Why is there a sort of natural law that should happen? Well, the company's still making the same pounds millions amounts of earnings. So if you're dividing that same pounds millions amounts of earnings, say the round numbers, £100 million of earnings, and you had 100 million shares in issue, so that would be £1 of earnings per share. Suddenly, if you buy back half your stock, you've got 50 million shares in issue, you're making £2 per share in earnings. So all other things being equal, you should pay a higher share price for £2 of earnings than you pay for £1 of earnings. And so share buybacks mathematically should work. So that is...
Should work.
They should work. It's funny, you never quite, as with all things which are meant to be scientific, there's this thing called ceteris paribus, which is all other things being equal. So other things sometimes get in the way. The best examples of buybacks is actually, I've talked a bit about tobacco already, but the great thing about a company which is in an industry where they've got pricing power is they can get into this sort of flywheel where they are doing the right things. They're not splurging cash on silly expansionary projects which don't make any sense. So they tried that. Imperial Brands tried that under the previous CEO, and it failed. So they've stopped doing that. So what they do, these Imperial Brands, is they generate a lot of cash every year. And what they try to do is they try to hand back. They've made a range. They're handing back somewhere between 2 billion and 3 billion of cash every year. And half of that will come back in the form of dividends. So we get that gently rising dividend with that sort of 1.5 billion of dividend money that we get back from them. But then they're also deploying 1 to 1.5 billion into a buyback. So you get a yield of, at the moment, somewhere about 5.5% with Imperial Brands. But you've got another 5.5%, broadly speaking, in buybacks. And again, going back to the maths, if you're buying back something like 5%, 10% of your stock every year, the number of shares is going down, your share price should be going up. And your earnings per share should be going up. So that's why I called it a bit of a flywheel, because as long as the company itself is still delivering, quite hard for that share price to go down if you've got visibility on rising earnings per share and visibility on reduction in the number of shares in issue. Go figure. It's one of those things where it's, okay, the maths will play out here. And that's why I've had that as one of my biggest weight holdings in the portfolio. And again, going back to how am I different? Because ultimately we all have to be different. We have to have an edge. There aren't that many active fund managers who thought tobacco was a very good idea. We have been among the lone voices there, I think, to say, look, people have got free choice about what they do, as long as the government regulates this industry and tells people the risks. There need to be somebody providing a product that achieves that. So we've stayed in tobacco. A lot of people didn't stay in, and now I think they're looking at the sector and saying, we thought this was a sunset industry. We thought this was dead. How can this be that the shares have just doubled? How did that happen?
Yeah. You just mentioned you're an active manager, and also you're what is called index-agnostic. Can you explain what that means and why that works for you guys? How that's an advantage for the trust?
So index agnostic, it goes back to the genesis of our industry, the active industry, was when I started in 1998, it was extremely wedded to the index. So the index will have, let's say, pick some numbers, but we'll say 6% in Shell, 6% in AstraZeneca, 5% in Unilever, and so you go down the list. And in the late 90s and 2000s, most fund managers would look at that index and they would go, okay, I don't like AstraZeneca. So instead of owning 6% of AstraZeneca, I'm going to own 5.5% of AstraZeneca. And looking back, we were getting paid fees. Active managers were getting paid fees for taking tiny little bets. And it wasn't really a clear reflection of that fund manager's views. Because if he didn't like AstraZeneca, he shouldn't have owned any of it. So that's where we're coming from. We're coming from a place where in the past, people have been hugging the index. Now, of course, if people want the index, they buy a passive fund. So that's answered that one. So what it means is that those active managers who are here need to be expressing their views very, very clearly and emphatically. And that's what we're trying to do. So we're saying, well, look, we don't care if the stock's AIM listed, small cap, mid cap, large cap. If we like it, we're going to own it. And we're going to own it in the relation to our conviction levels in that stock. So again, going back to those names I told you, they happen to be large cap names, but we've had over 10% in the last few months in names like Imperial Tobacco and British American Tobacco. So we've had over 10% of our portfolio in those two names. I have taken some profits in recent months, but that's been broadly the weighting for those two stocks. But we also have around 4% of our portfolio in a small cap name like Galliford Try, which is exposed to the rising need for new hospitals, new schools, new prisons, you name it. The crumbling infrastructure of the UK needs to be replaced. And so you've got people like Galliford Try waiting in the wings to do that.
I've mentioned at the start of this podcast that you won an award from us this year for the trust. Is there anything else that you feel has been a major factor in helping to drive that performance?
Well, the performance should be a result of the process, and what I'm thrilled with is value is back. So when I say that, I mean actually taking a step back, you can now, with the benefit of hindsight, see why value was out of favour when it was. So for much of the period of ultra low rates, when there was QE, feels strange to say it now, but rates got down to 0.1%, and you think to yourself, what kind of world was it? We thought 0.1% base rates.
It was a good world. It was a good world.
It was a good world. And do you remember when it was about 30% of corporate bonds and government bonds were negative yielding? So you had to pay to own a government bond. I mean, these were crazy times. But of course, in those times of basically zero rates, going back to the way people value stocks, they would then say, somebody would come along and say, here's a super duper technology stock, which is not making any money today. So it's making zero profits today. But in 10 years' time, it's going to make lots and lots of profits. And what investors would do back in that environment, where they would say, what's the discount rate? And the discount rate is if you know you're getting money in the future, you do need to discount it back, because the simple reason that time has an effect on the value of money. So in £100 today is worth more than £100 in 10 years' time because of inflation, because the uncertainty you may not actually ever get that £100. So you have to put a discount on the £100 in 10 years' time. And what investors were doing is they were putting no discount whatsoever on that £100 in 10 years' time, which meant that you ended up with these ridiculous valuations on growth stocks. So now that we've got the benefit of hindsight that actually base rates are not going to be 0%, possibly ever in our lifetimes, it's a big call, but there are new forces unleashed on the world economy that should prevent base rates ever going back to 0%. So what I mean by it is look at all the bad stuff going on in the world at the moment. Look at all the war, all the trade stuff. Look, it's pretty tough. It's all inflationary. There are lots of wage demands. Wage demands are generally being met And you know what? It's probably to keep people at bay because people are not feeling good about their lives at the moment. So they need that pay increase. So services inflation is staying stubbornly high. Base rates aren't going back down. So what does that mean for value? Well, value stocks make money in the here and now. If you own a company that makes paper or cigarettes or whatever it is, you're not that bothered. You're not as bothered as you would be if you had a tech company about the 10-year view, because the tech company needs the 10-year view to be correct for that stock to be worth anything. Going back again to that tobacco company, the tobacco company is making a free cash flow yield of 10, 15% here and now. So you're not having to take a big bet on what the outlook is in 10 years' time. You just keep rolling that cash flow year by year. You generate the income, you pay the dividends. Soon enough, you make your money back. And so I think that's at the root of what's going on at the moment. This compression in dividend yields is people are saying, it's really tough out there. My cost of living is huge. I need something which is going to pay me a dividend and an income. And so you can either try and do that yourself, and I'm sure a lot of your listeners and viewers will be perfectly capable of having a look at the stock market and saying, that stock's in a good place, that stock's in a good place. You don't have to overpay for these stocks. I'll put my money in that. But some people are going to say, well, I'd rather have a vehicle and let somebody else do that hard work of analysing the companies and making those views. And then at the end of the year, you've got a pretty good chance that you're going to be generating X% dividend yield. I've got a 24-year history to defend here in terms of our dividend growth track record. I don't want to be the fund manager who breaks that 24-year growth in our dividend per share. So I'm in there every morning in the office looking for companies that can achieve that dividend growth and keep that dividend growth going in my portfolio. So that's really why I think it's coming of age as a sector, which is, and the reason it's had a break, the reason it had an interlude for the last 5 years, even you could even argue more than 5 years, you could even argue sort of up to 10 years really, when people weren't that interested in income. And I think the interlude related to that temporary shift towards zany valuations and ridiculous, DCF models, discounted cash flow models that were based on discount rates that were razor thin so that you could then justify this enormous share price for your growth stocks. And I think that era is done.
Yeah, understood. I wanted to bring you on now to the world of politics. It's something that's impacting UK stocks now. I mean, we're seeing a lot of the sort of FTSE 350 stocks are coming out with numbers, and they're blaming national insurance hikes, for example, as eroding their profitability. What's your take on that? Do you see that as a major threat to the UK equity market?
I am going to surprise you, given I'm a UK equity manager, and say there are real risks. I think most UK equity managers would say, oh, it's all going to be fine. Look, the first thing to say is, of course, the boring answer is UK companies, partly because of our history as a country, we've got tentacles everywhere, all over the world. We've got companies that have existed in multiple continents for decades. So we've got plenty of overseas exposure. And if you look at, even if you think about a simple sector like mining,
tobacco.
Yeah, exactly. So these sectors have existed. And for historical reasons, London's been a place they've listed. So I've got no shortage of countries, sectors I can invest in. So, but let's go back to your first question, which is about the UK. I am nervous. I'll tell you why. You hear this term doom loop. I know it's getting a lot of headlines at the moment, but when you go through the logic of why people are talking about the doom loop, you've got to give it some credibility, that the risk that we could be somewhere on the route towards this doom loop. Now, I'm not saying it's going to happen, but some things have to change for it not to happen. So what I mean by the doom loop, really, to put it in simple terms, is really that we've got 100% government debt to GDP. So if you start with that assumption that GDP growth needs to go up because government spending is going up and we have a deficit every year. We have quite a big deficit, actually. We have about sort of 4%-ish deficit every year. So the ratio between government debt and GDP will keep going up until we get some GDP growth. At the moment, we're stagnating as an economy. So that's not a good starting point. Bond markets have spotted this. So bond markets, when I go and see my fixed income colleagues in the office, they're talking about auctions for government bonds here in the UK that are not going very well. And you ask them why, and they will say to you, well, you know what? People are looking at the latest growth data. They're looking at the latest government spending. They're looking at the latest tax rises. And actually, a lot of these tax rises, well-meaning though they are, they're not actually ending up raising very much money. Because you put taxes up and people do less activity or they leave or whatever it is. So it's getting harder and harder to raise taxes. It's getting harder and harder to convince bond investors that they should be trusting the UK government with their money. You look at this in aggregate and you think, ooh, we've lived through some crises over the last 20 years. We've had the GFC, the Great Financial Crisis. That was a big deal. But debt levels weren't where they are now back then. I'm nervous. And I'm positioning this portfolio in a way that I would expect it to do reasonably well. I mean, look at the tobacco names, for example. Rio Tinto. Is Rio Tinto going to be a stock that collapses if the UK government ends up in a doom loop? No. It's all about China. So I can populate this portfolio with plenty of names which are not exposed, but I think we need to be very, very mindful of that.
This is something that people started to do after Brexit, where some investors I spoke to, some fund managers I spoke to, were looking at stocks and UK listed stocks and saying, what's their exposure to the UK? How dependent are they on selling into Europe? Are things going to change for them? And at that time, some of them were saying, oh, we prefer stocks that have massive exposure to the UK, very little exposure to Europe or globally, because those are the guys we can rely on, at least over the medium term. Now what you're saying is start looking at companies that have that international exposure and less of the exposure to the UK economy.
And I would even go further and I'd say if we critique the rationale for people avoiding UK equities back in 2016 post-Brexit, was it actually relevant to the revenues of a UK retailer? I mean, at the margin, you could argue GDP growth has been a bit slower because we've had less trade, less free trade. It's been a bit frictional. It's all just jammed up a bit. And confidence levels have been a bit lower, and therefore investment levels have been a bit lower. I think what we're looking at now is a whole new level of risk, because at no time during that post-Brexit period did the whole system just jam up and stop working. And we really need something to change. So we've got the budget coming up. What the Cabinet do in terms of the balance between government spending. So you and I in our daily lives, we would make sure that the money we're spending is on the right things. You sometimes go through and you think, have I got so many subscriptions? So I'll just cut that subscription, I'll cut that subscription. Whatever it is, you go through your life and you look after your money. I do wonder whether the government needs to do something similar. The pushback is going to be massive, whatever they try to do. But I think what bond markets seem to be saying is, you do a bit of that, we're more likely to give you some money. At the same time, austerity isn't popular and austerity can hinder growth. So how do you get the private sector to succeed? And in fairness to Rachel Reeves, what she's trying to do at the moment is quite sensible. She hasn't got any money. She won't say this, but she hasn't got any money. Therefore, she needs to find ways to stimulate the economy which are not pump priming the economy with huge amounts of spending. So she can loosen regulation a bit at the margin. She's doing that with the housing market. She's doing that with financial services. So, relevant to this sector, we know investments and wealth and so on. It's likely that in the next 5 years, you'll be able to access advice a bit more freely than you have done the past 5 years. So all of that is probably quite sensible. It's free as well. So changing regulation costs no money. So I started with the risks. I'll end with, in terms of the UK section of this, this conversation we're having. It's sort of, there's a possibility if she does enough sensible things to get the conditions into the right place to drive up economic growth, maybe that's the route out. But the problem is, at the moment, what are we, 1 year and 2 months in? Growth, not happening. So let's see. Maybe it's too early to judge, and maybe everything's going to fall into place. But right now, I would say, you need to position your portfolio in a way which is sufficiently skeptical that the good news is just around the corner, that you'll still make money for your shareholders if it doesn't happen.
And very quickly before we finish, tariffs, US tariffs, have you seen much impact from your perspective from those? Obviously, UK has a better deal than many countries at the moment.
No, it's amazing. I mean, look, we thought it could be a big deal, but at the margin, could it slow things down a bit? It'll make people just, maybe they'll relocate one factory and they'll find ways around. But it's amazing how nimble companies are. Companies are able to relocate. They're able to do what they need to do to make things work. And ultimately, that's the great thing about companies are fleet of foot. One thing I would say about companies, they know how to pivot. So you speak to a management team, and I'm wondering, I'm being a bit nasty to our wonderful MPs of all different colours. I'm saying this with all best intentions, but MPs may not be as good at pivoting as company management teams, because if you're a company management team, ultimately your duty is to your shareholders, and if you don't pivot, somebody else is going to come along and eat your lunch. You've got to find a new market. And so, or you've got to relocate your factory, whatever it is. They're good at doing that. And so, let's hope politicians are also good at doing that, Stuart.
And apologies to any MPs who may be listening to this as well. Thank you very much indeed for coming on the podcast, Thomas. That's been great. Could chat all afternoon, but hopefully we'll get you on again soon.
Great to be here.